Chris Picciurro. Chris has been a CPA for more than 22 years and spent the last 16 years as founder and executive officer of Integrated CPA Group. Since 2003, Integrated CPA Group has grown from a small one-office operation to a multi-state firm servicing well over 3,000 clients. And taking one look at your LinkedIn, Chris, you CPA, MBA, PFS, AARA. How you doing today?
I'm awesome. And so I've been doing this CPA for 22 years. So I was the youngest person to pass. I was 9 years old. So Doogie Howser, the CPA, no, I'm just kidding.
When Moses was wearing short pants.
Exactly. I am awesome. I appreciate being on your show. I was able to catch some episodes today, and I'm originally a Detroiter. I live down here in the Nashville area now, and I miss a lot of my Canadian friends, and I have fond memories of Ontario. I actually got engaged in Niagara Falls, and then I went to Windsor and Sarnia too many times, but that's before the CPA license, so we'll leave that out.
Right on. Yeah. So you're only a few hours away. So for listeners today, especially, the Canadians, Australians, the others across the pond in Europe, what was so great and the reason I wanted to have you on was that you are an expert in foreign investment into the U.S. And, sometimes eyes can glaze over when we're talking about liability, legal, taxes, but it's important stuff. And I'm so happy you're here so we can have this conversation.
Yeah, I'm excited about it, and we have so we're a CPA firm, or we have a niche in helping real estate investors and entrepreneurs. I would say they kind of go hand in hand. Many of our foreign nationals are entrepreneurs in their native country and have accumulated some assets and wealth, and I'm sure we're going to talk about why people invest in the United States. But so yeah, we have a lot in common, and we just started about 12 years ago, really getting into, felt like a lot of us, even though we've been in the firm for 18 years, about 12 years ago, we really started falling into helping real estate investors, specifically foreign nationals. Our tax code, unfortunately, calls them an alien, which I don't like that term. But yeah,
it's a political year, especially. You know what I mean?
Oh, I know. But we've had we've worked with over the years, clients in over 30 countries. So that's been pretty cool. And we've worked with a lot of. We started doing this about 12 years ago and creating continuing education opportunities for the National Association of Realtors, National Association of Residential Property Managers, and just from there, creating those CEs, we were able to help those trade organizations with the tax compliance, and then essentially helping the investors with strategy and planning.
Wow. So that's fantastic. Before we get into everything right now, why don't you tell listeners a little bit about your background and how you initially got into real estate and specifically, the vertical of accounting and taxes that you're in now?
Well, I always liked numbers. And I was one of these people that I wanted to be a CPA back even in high school. Like I said, once I realized I wasn't going to be on the Detroit Tigers, I realized I had to find another opportunity, which was pretty young. So about, ninth grade, I started realizing that I really love numbers. I love accounting. And I tried, I worked at other CPA practices before I started my own practice. And I just had an entrepreneurial spirit. And I knew that I wanted to, and I try to mentor some of the younger CPAs now that are just kind of trying to grow their business. And my kind of took my own advice. So we always say we eat our own cooking, and I love real estate. I love it. I involved myself in investing in real estate. And I just felt like if you're a professional service provider and you want to love what you do want to do your hobby for work, then go in the industries that you really love. So I just got into that, coupled that by, we have a kind of an internal saying here at our firm to let your best client pick your next client. So all of these clients were in real estate, and they were referring us and then referring us to their investors. And I love travel too. And kind of the neat thing is that even though I haven't been to all 30 countries that we have clients in, I felt like I love meeting the people from different countries, not just myself. We have an awesome team of people that we, sometimes we Zoom meet with them. Sometimes they come to the States and in person and meet with them. But and when I say meet, sometimes it's just a talk like this, but you get to know them, and we're able to. I love different cultures. I just love finance, so it just was a fun niche to get into. So we have a domestic practice, and then we have an international practice. So in the international practice is specifically what we call inbound tax. So it's people that are foreign nationals investing here in the United States, where most firms focus on U.S.-based companies that are investing overseas. And there's just, that, so that's kind of our differentiating factor.
Okay, very cool. So you initially got involved into real estate, and you're an investor yourself. You buy real estate. Out of curiosity, what type of what asset class do you like to invest in?
So we have had commercial property that was usually it was just offices that we operated our practices out of. So myself personally, I like single family homes. I just feel like they're easy to sell. They obviously they have inherent challenges, and I'm very passive. So I personally employ third-party property managers in general, and then a lot of cities usually that you can. We're always trying to get at least the 1% rule. We want to make sure
you Americans, unbelievable.
We want to. So Toronto wouldn't be a good spot to invest. We're looking to to make sure that the laws favor a landlord and stuff like that. So honestly, I've learned so much from clients. Because you can't, like, my whole job is to legally and ethically reduce the taxes you pay in your lifetime. So when I have clients that are like, you actually, obviously we implement cost segregation studies and do different strategies with 1031 exchanges and all that. But yeah, when I see the cash flows coming out of some of these markets, I'm like, okay, I see you. I gotta. So anyway.
That's funny you mentioned that. We have a monthly meetup for foreign investors. It's typically Canadians invest in the U.S. And we were talking with some operators in Buffalo. And when they say the cap rates out there, we're usually like, come again? What was that number? Just because they're so hard to achieve unless you're going to super tertiary markets in Canada. But so maybe you could take us 30,000 foot view of a little bit of the background of how the U.S. treats foreign investors when they're investing outside of the U.S. in real property, income-producing property in the States.
Well, I feel that our tax code, so our big picture, the U.S. tax code does one of two things. It rewards certain behavior and it deters certain behavior. So it rewards, in general, real estate investing. It's one of the few industries that you can be in that you could have, we call it a positive cash flow and a zero tax flow. There's not many places that you can do that. So a lot of the tax benefits that we have as U.S. residents, and I should probably start by saying U.S. tax residents, a foreign national would have as well. The rules are really interesting. You could be, for instance, a U.S. tax resident for income tax purposes, but not for estate tax purposes, and vice versa. But in general, the rules are very favorable. And then the next thing you have to look at is, what country is the foreign national from? Is it a tax treaty country, or is it not a tax treaty country? In general, a tax treaty country is going to be an ally or someone that this country, the United States, plays nice with. And Canada is probably our best ally. And then when you start working with a lot of clients from that country, you do have to develop your network. So we do the tax planning and strategy. We have to develop the lending side. We have to develop relationships with the legal side. And also, I'm not an expert in provincial and Canadian tax returns, but we have to know the interplay between the tax credits there, and just understanding that in theory, you want to have a positive cash flow, and you want to make sure you're not subject to double taxation. And one of the things I always talk about is reduce the taxes you pay in your lifetime. That includes income tax, but it also includes estate tax, and understanding what the rules are here versus what the rules are in other countries. So I would say specifically for Canada, it's very favorable, and that's why we're seeing this. I mean, I want to say from 08, 09, all the way probably to 12 or 13, Canada represented the largest percentage of foreign national investment here in the United States. I don't have it in front of me for a variety of reasons. I mean, you know, the loonie and the dollar, right? I mean, they were like par.
Yeah.
For a while, but, you know, it's been 1.5 to 1.6 to 1. So when our real estate market really came down and the Canadian dollar was strengthened, the US dollar was weakened, that's where we saw a lot of investment. You know, because we're looking, I mean, I always think about the example of, I mean, where does everyone go from Canada? Hallandale Beach, right? Aren't they all? A lot of clients there, a lot of clients. If you're from Vancouver, you're probably going to Arizona. It's just, it's weird to see these patterns. Yeah. And, but yeah, so let's say they buy a condo in Florida. That condo could have been, $400,000 US, which would have been 600,000 Canadian. The condo goes down to 200,000 when we hit the skids. And now it's 200,000 Canadian. So it's on, you know, 1/3 the price. Not only that, they can also rent it out and pretty much cover their whole nut. Yeah. Now, once they start renting out the property, there is a lot more tax compliance to consider. But that's kind of the landscape. So the Canadian investors, you have a lot of advantages here. The one takeaway you should be very aware of, though, is that the CRA, Canadian Revenue Agency, they don't. So LLCs are very popular in the United States. Limited liability company. Yep. People think it stands for limited liability corporation. It can be a corporation, but it's a limited liability company. The CRA does not recognize a U.S. LLC as a transparent entity. So what happens is you might get double taxed. So a lot of times, investors are coming over here. They might come to an event where people, you know, turnkey rental property sale event.
Some guru says must get an LLC.
Exactly. So based on, you know, their situation, you know, obviously you have to consider asset protection, estate tax, et cetera, et cetera. But what we were seeing is, unfortunately, that a Canadian national would buy a property here, put it in an LLC, and now they have a bunch of tax reporting here that the LLC has to file a corporate tax return here, and you have to file a personal return. You still have to get an Itin, and you're not even getting the tax credit in Canada for your U.S. tax because the CRA. So there's workarounds. Sometimes you know an LLC here might elect to be taxed as a corp to avoid the double taxation, and that hedges you against estate tax. But again, I promise I'm not going to get into the weeds too much. Its bottom line is you got to diagnose, prescribe, right? We got to look at the client situation and figure out what's the best. You know, it's always better to do structuring before you buy, but usually it's an afterthought. So if we go in, so I want to talk about LLCs, limited partnerships. I want to get into that, but why don't we go from, you know, I'm a visual guy and this is, you know, audio. So let's, you know, for me, the best visual is a bit of a case study. So let's talk maybe one of the most basic examples that we could do. You have an individual who is, for whatever reason, not worried about liability protection, is buying a single family home to rent out in the US, and he's going to own it in his personal name. Okay, it's tax time, or even before that, he has income coming in. You know, what are his implications, withholding tax, the such and such? No, this is great because we did this case study and then we built it out. We had the opportunity to go with one of our clients to Montreal, Toronto, Vancouver. I actually went to Edmonton for like 4 days, which is pretty cool, a while ago. And we did a Canadian US example. So
well, I guess one addition to this would be, and correct me if I'm wrong, in this example, the answer would probably, just because it's still a personal and we're not talking LLCs yet, this could be an Australian, right? This could be anybody that we have or you have a tax treaty with.
Right. Okay. So let's say we're a Canadian national, could be Australian, but Canadian national specifically with the LLC rule. You come here, you buy a property in your own name. You don't have asset protection. That might not be a concern of yours because, again, I'm not an attorney, but you're going to have a property management company. You're going to have property insurance, et cetera, et cetera. First thing is your rental income. Your gross rental income is subject to a 30% withholding tax, FERPTA tax, because by default. So your first step's going to be, let's get you an Itin. Let's get you a W-8 ECI, it's the name of the form, and let's provide that to your property management company. So you are making, I promise I wouldn't get too technical, but you're making an effectively connected income election and electing out of the 30% withholding.
Okay. And before you go there, and I don't mean to interrupt, but just for those that don't know, Itin is the identification number, the tax number, right?
Yes, that is the social security number equivalent for a foreign national. So you have to get that, and it's tricky. You would think that our government hands out ITINs like candy because they want to identify people, but they don't.
Yeah.
So you have to, so our firm's what's called a CAA, certifying acceptance agent, and we kind of act as an intermediary for the IRS where we have to verify someone's identity. We have to get a letter from the property manager. There's just some red tape we have to go through, but we can get so you get the identification number. You can also apply for an ITIN when you file your first tax return here. So basic example, buy a house. You're going to be subject to the 30% gross withholding. Let's elect out of that. Then you will also enjoy the depreciation deduction on the property. You get to deduct all of your cash expenses. You get to deduct your mortgage interest if you have it. And you also get to deduct the cost of the property in general over a 27-year period. So point is, your cash flow is a lot better than your tax flow. Mm-hmm. Your tax in the United States, if it's over 10%, I'm shocked here. So
in the event that, okay, so let's just say we have a fantastically profiting investment so that your depreciation is not covering all your tax liability. Sure. The eventual amount that you do have to pay taxes on, what is that? What are the implications on a state and federal level? And then when are you actually paying that? Are you paying that in the States and doing a credit in your home country, or how does that work with our example here?
Sure. In our example, yes, you would pay your federal tax. So option one, you're okay with them withholding 30% of your gross rent, and you just take that as a credit on your return. That's a really bad option. Option two, you just pay at the end of the year with your tax return. In general, the 1040 NRs, because that's the form you're going to file, are due in general June 15th, not April 15th, like our domestic returns. And then, or if it depends on how much you owe, you could pay quarterly taxes, but it's very rare.
Yeah.
You're typically going to get a credit in your home country for the taxes paid. Every state's different. We're seeing that a lot of the states that are thriving right now with foreign investment have no income tax. So I'm in the state of Tennessee, state of Florida doesn't, state of Texas does not, so Nevada does not. So state by state, there could be a state tax or state tax withholding. So yeah, that's kind of the fact pattern.
Okay. So if we complicate that fact pattern a little bit, so for listeners too, I think the LLC in the States, the benefit of that structure is that it's a flow through, and that you're going to be taxed at your marginal rate. And the only Canadian equivalent that I'm aware of is a Canadian LP, a Canadian limited partnership. We don't recognize LLCs. I believe the CRA treats them as corporations. And you talk a bit about the issues of if this individual in our example puts the property in an LLC, why does he get bad marks for that?
Exactly. So you hit the nail on the head, because the CRA considers that a corporate entity. So you're getting taxed personally in the U.S. You're not getting the credit in Canada for the tax you paid, and then turning around and paying whatever the corporate tax is in Canada. So that's
sounds like a lot of 1-2 punches there.
It does. And to complicate it, so with a 1040 NR, which is your individual tax return that a non-resident foreign national, let's say you say, I'm going to buy this with my spouse. Well, now you have two 1040 NRs to do, so, or I'm going to have an LLC with two partners. Well, whenever you have a partnership here, it could be a limited partnership, could be an LLC. If there's profit in the partnership might have some withholding for those members. But let's keep it easy. Yep. That's why sometimes it's better if we have someone that forms an LLC here and they realize that, that's not good. You have the first 75 days of any year to elect to be taxed as a corporation in the U.S., which is kind of nice.
So that would
Because
be a U.S. Would that be an S corp or a C corp?
a C corp.
Okay.
Yes, it would be a U.S. C corp. And in that fact pattern, now you're subject to corporate taxation. If you have a tax, it's 21% right now. But again, most of these, it's rare we see tax being paid, because if you're cash flowing really well, we might do a cost segregation study. What that means is that we're taking we're accelerating the depreciation or the cost recovery deduction on the property.
Yeah.
And then the other nice part about that is that you are also avoiding U.S. estate tax, because our estate tax exemption for a non-resident is only $60,000. That's very low. Now again, there's treaty benefits you can apply in treaty states, but it's just, that's why we have to look at it. If it's a property that you say, it all starts at the beginning, right? Was a client, if they say, I want to buy this property, I want to rent it out I want to go to Florida, I want to golf, I want my kids to own it. An entity's probably not your best option as far as like an LLC or a corporate entity. You're not going to get what's called, not to go in a million directions, but a step up in cost basis when you pass away. Potentially some type of trust or something, that because you also don't want to get tangled up in probate court if you pass away and you own the property personally too. Okay. So yeah, it really depends on what your objective is. We have a lot of different rules, right? But there's a lot of opportunity too.
So if you move through that, let's talk about the C corporation. Okay. Say I buy a property. It's a $1 million property, a multifamily property in the States, and I put it in a U.S. corporation. The U.S. corporation, in the event that it is taxed or there is income subject to tax, now I'm taxed at the U.S. corporate rate, which now, if you could remind listeners and myself, what's the U.S. corporate rate now?
Well, under the TCJA Tax Cuts and Jobs Act, effective 2018, it's 21% flat rate. Okay. 21, which is very low.
Lower than you've ever had it in the past, correct me if I'm wrong.
Correct. Now there was a tier structure where the first 50,000 was taxed at 15%. That changed. Bear with me. Let me grab a sip of water here. Sorry.
No problem.
Now, I don't know if you guys realize we have an election coming up. So
not a tax election, a real.
Right, exactly. We have a real election. So right now, that's a big issue. Where Joe Biden's proposal is to take that corporate tax rate from 21 up to 28% flat rate.
Not insignificant of an increase.
So 33% increase. So, wow. And so that's something to consider. And when you're doing the structuring, but let's just pretend we're playing. We can only play with what we know right now. So there would be a corporate tax of 21%. Now the issue becomes, if it's $1 million property. We have to look at how many owners there are, and let's say you want to take money out of that corp. Well, if the money is taken out of the corp to the individuals, then you've got a dividend, which could be, and each owner would have to pay a corporate, the dividend tax.
A return, a tax on that.
So probably $1 million structure. We're going to make sure that we get attorneys involved that only specialize in this. We're probably going to do what's called a 2-tier structure. Have a Canadian corp. Have a wholly owned U.S. corp. Okay. And then the U.S. corp's going to kick distributions or profit distributions to the Canadian corporation, so that what we're trying to do is we're trying to shelter the individual owners of that of the property, which is owned by the Canadian corp, from exposure to tax obligations here. So if there's one owner, maybe we might change it. But a lot of times what we see is you have, 10 guys get together, girls, we always put $100,000 in. We don't want to trigger a state tax and income tax on the individual level on everybody. So in that case, a 2-tier structure might make sense.
So Chris, if just tell me if I have this right, because we employ a holding company in RealCo structure, where a RealCo is a company that owns the asset. We have a tax-free dividend that goes up to the holding company because they own the RealCo company. And it's basically to get income out of the RealCo in the event that somebody's sued.
Right.
In this structure, the Canadian or foreign corporation owns the U.S. corporation. Is that you can kick that money up tax-free? Is that on a tax-free basis? And then if the Canadian corp distributes to individuals, then you're taxed. Is that right?
Correct. That's the idea. That's the idea. In obviously there's rules and regulations. We have to look at the situation, but that's what we're trying to do, so that we're not getting double taxed.
Yeah.
And we're not, because if you have a Canadian corp own the property directly here in the U.S., you get subject to what's called branch profits tax, and there's some other, really it comes down to how many owners do we have, and we want to deal with the compliance costs, like filing returns and ITINs, and we don't want to entity ourselves to death. So, but it is similar to the structure you're talking about.
Okay, that's great. And maybe another thing you could demystify for us, or give us some clarity on, is we hear constantly, I'm pretty sure this is the case for other individuals that invest in the US, of different states going to Delaware, forming a corporation here, forming a corporation there. When you have just somebody that is looking, like you mentioned, Florida, that's buying an income producing property in Florida, do you create the corporation and structure in the state that has the property, or are there other states that you specifically go there because of their advantages?
Right. Well, good question. I'm not an attorney. Not that I'm trying to dodge your questions, but I can't practice law, so I don't want to end up someone coming after me for some reason. But in general, right, we know that Wyoming, Nevada, and Delaware are very popular places to form entities, and the reason is that in general, that they have there's a more anonymity there, and also if something happens, they have more
case law.
Yeah, the case law, and if something happens, they know that the case is going to have to go to that state, and the case law supports that state. It's more pro-owner, if you will.
Yeah.
I guess it comes down to the structure. I mean, if I'm buying a $250,000 condo. Nice condo in Fort Myer. Used to be really nice in Fort Myer. Now it's okay. But let's say you do that. Am I going to go through and make a Delaware, LLC, and then have to register that in Florida? I don't know that it's going to be worth it. You know what I mean?
Yeah.
But if you're doing an apartment complex, it might be worth it for the asset protection. So those states in general have better asset protection rules to the owner. But in that case, I would bring in another resource.
Okay, that makes sense. And one of the, I'm gonna complicate things just a little bit further, and then I'm gonna bring them back to some more general questions. But one of the things that I've heard, and you can tell me if this is accurate or if this is just nonsense. But one of the things I heard in terms of individuals that are, say we use that example again, $1 million apartment building. I have heard when people create limited partnerships, and now this is an entity that the Canadian government, the CRA, recognizes. I've heard that if you invest using an LLC as the general partner and the individuals and investors as the US LP, as the US limited partner, that income from there can go through the LLC and it's going to be taxed as a corporation for the states, from the Canadian point of view. However, the limited partnership agreement makes the GP a nominal owner, so a 1% or 0.01%, like we see with a lot of these structures, and then 99% to the LP. Whereas my understanding is that now the Canadians, part of the US LP, have limited liability protection, but they are in a flow-through situation by that. Oh, can you hear me okay there?
I lost you for a second, but I think. Sorry about that. Yeah.
No problem. So my understanding is that this structure would achieve that limited liability from the Canadians, and then being able to pass through for them to be taxed at individuals. Is that a myth, or does this make some sense?
No, it's a popular structure because you have it's a GP-LP structure, so that the limited partners are not the. So in the U.S., when you have a partnership, you have limited partners, you have general partners. In general, general partners bear the liability. So a lot of times what happens, and you cut out a little bit, but I think I know what you're talking about, where the general partner is going to own 1%, 0.5%. It's probably going to be a corporate entity. And then the other 99% could be individuals, but they have a limited partnership interest, so their asset protection is still there. That way, on the Canadian side, they're not the LLC; they're a limited partnership. And the nice part about limited partnerships and LLCs here in the States is that you can have a limited partnership that says, I own 50% of the property, but I get 25% of the profit, and I get only 5% of the loss. So it's almost like you got some Play-Doh, where a corporation, you could have different levels of stock shares, but it just gives you a lot of, so that if you really wanted to, you could probably swipe the profits out, move it over to a corporate entity that might be, at a lower rate, or depending on how things go.
So from the tax point of view, when a U.S. limited partnership, when say that U.S. limited partnership sees a taxable income of $100,000, for instance,
sure. Yep.
Is that immediately flows through to the members of that limited partnership, and then that's taxed on their normal returns? And if so, if those are Canadians, do they file in the States and then file for elections in their country of origin?
Yes. So a limited partnership is what we call a transparent entity here from the federal level. So there are some states, like in the state of Tennessee, a limited partnership actually is not taxed. We have a franchise and excise tax on LLCs. But from the federal level, the limited partnership itself is not taxed. It will issue K-1s, which is the name of the form, to each partner based on his, her, or the entity's ownership percentage and what is in the partnership agreement. If it's an LLC, it's an operating agreement. The partnership agreement dictates how we distribute those profits. And it could be, and that could change year to year. It could change. So at that point, though, if someone is a non-foreign national, non-U.S. resident for tax purposes, is a partner in a limited partnership, there is potentially a withholding requirement by the limited partnership to send in some type of federal tax. That tax then is taken as a credit when you file your personal return. So let's say you own 5% of a limited partnership and your share of the U.S. income is $100 or $10,000. You would have to file a 1040 NR, and you would report, I have $10,000 worth of income. Oh, but the partnership was required to mail in $1,000 of tax. Okay, I get a credit for that. So where we see trouble is when partnerships. So when we say partnership is a taxable entity here in the States. Partnership could be an LLP, an LP, an LLC. That's just how you're taxed. But a partnership that's supposed to withhold tax that doesn't, that's where your risk is. And I think just in the U.S., where our compliance environment, we're finding that the IRS do they want to come after, Jesse over some travel expenses, or do they want to come over after Jesse LP because you didn't withhold tax for 10 people? Yeah. They're going to come after the entity. And that's why one of the first things we said is that the FERPTA withholding, the property managers know now, if they don't, they need to. Over the last 10 years doing these education events, like, oh man, I should be withholding 30% tax. So they want to cover themselves, because if they don't have the Itin and W8 from the owner, guess what happens? It's 30% penalty plus penalties. So what we're finding is, in my opinion, I think the IRS is going to really focus on increasing their revenue by penalties and late fees, not by tax.
Interesting.
Because the LP doesn't owe any tax. But if the LP was supposed to withhold, and the other thing is, now let's talk about our Australian friends, because Australians are going to be more likely to form a single member LLC here. Mm-hmm. A few years ago, there was a law change where a single member LLC owned by a foreign national in the United States has to file a 5472 form. I know we're getting technical, and attach it to a 1040 or 1120, which is our corporate tax return. So for our U.S. listeners, it's the inverse of an FBAR report. No taxes due on this, but the penalty is $10,000 if you don't do it.
If you don't
People
file.
didn't know it. So yes, we had one person come to us that wasn't a client. They ended up getting a $20,000 penalty And we ended up getting it abated, thank goodness. But still, it's that's where the structuring. Like I said, I really focusing on compliance, the tax preparation side. Again, there's not much meat on the bone. Our tax rates are low. So do they want, someone want to fight you over some travel costs? I mean, it's not worth it.
So you mentioned something that has come up a few times, and that was the K1. And, that is, we have an equivalent partnership return that we file, and I'm sure most countries file. What I'm curious about is it's a good segue into some people want to invest in the US as complete passive investors in the form of being a limited partner for, you see all these syndication deals in the States. Sometimes it's 50,000 minimum, 75. Typically, you have to be an accredited investor. When you do invest in one of these, so let's use Grant Cardone. Everybody knows Cardone Capital. You invest in this syndication as a limited partner. You're going to be issued a K1 by that company or by that partnership. As a foreigner, when you get a K1, walk us through what you need to do. I'm assuming it starts with having an identification number, and maybe you could walk us through the next steps of that.
Absolutely. So, first step is, let's assume, you're an individual. You have you're a limited partner. You're not worried about asset protection, obviously. The partnership itself is going to have some type of compliance, hopefully. And someone like that
don't invest if they don't.
Right. So they're going to say, hey, we need your Itin number, and then they'll ask you for a W-8 series form. Sometimes it's a W-8 ECI, sometimes it's a W-8 BEN. There's a few different forms. That gets now the partnership, but they're at least going to ask for your Itin number. Okay. If you don't have an Itin number, the fact that you're investing in a syndication will allow you to get the Itin number.
Yeah.
So typically that partnership's going to issue you a K1. In general, the first year or two, you're going to have massive losses because the partnership's most likely going to do a cost segregation study, and your K1, even though it's a positive cash flow, in those fact patterns, we're seeing a lot of mobile home parks coming in really nice on the cost seg studies. So you're going to get this K1 with a big minus on it. At that point, you don't owe any tax. You still have to file your return. You take that K1, you file a form 1040NR, which stands for non-resident, and you report, I have a loss of, if you put 100 in, you might have a loss of like 50, 60, 70,000 year one.
Wow.
That loss, that loss then will carry forward and offset future income, future revenue on the K1.
And to just put a pin in that there, is that offsetting future income, does that stay in the boundaries of the US, or can you use that for Canadian earned income?
If you're a foreign national, it only offset, because if you're a foreign national, the US is not going to tax you on your Canadian revenue. You only have to pay tax on what we call US situs revenue. Now, if you come here too much, which now during COVID is not a big issue, but if you come here too much, remember I said you could be a US tax resident, but not a U.S. tax resident for state tax purposes. There's something called, assuming you don't have a green card, but there's a whole look back period on 3 years. How much time did you spend here? Did you establish U.S. tax residency? And unfortunately, if you do, you're taxed on your worldwide income. If you're a U.S. non-resident for tax purposes, you're only taxed on your U.S. source income. So in that fact pattern, you would get the deduction here. It would carry forward and offset future K1 earnings or capital gains. I don't know how it's handled in Canada, so I can't speak to that, what they do with your U.S. loss. But I would say here, so you would get the K1 loss. If you have a profit, like let's say after, they took a lot of depreciation deductions, the cash flows are good, they have a K1 with a profit on it. The limited partnership, if you're a foreign national, they're probably going to have to withhold tax on that. That's okay though. Yeah. Your K1's going to say, okay, I have U.S. tax paid. You can get that back when you file your tax 1040NR, because you might still have those deductions carried forward. And you could probably use the, when you do, say there's a capital event in the syndication, either a refinance or a sale of the property you've invested in, you can, if I understand that correctly, you can use those accumulated losses to offset that eventual gain. Right. Awesome question. So yeah, but so debt restructuring. So a lot of times, as you know, people are putting money in, buy undervalued property, underproducing, they get it going. You getting your cash out without selling the asset is not taxable. It's just a return of capital. If you sell the property, then yes, any passive activity losses that you have, that's what, which would be the loss from the K1. Why is it passive? Because you're not actively running the syndication. Those come into play to offset that gain at that point. You can also run. We have a lot of weird rules as far as basis issues. For instance, you have to have what's called basis in an entity to take the losses, or they carry forward. You can have basis by assuming some debt or being responsible for debt. I know it's getting really technical, but the bottom line is losses are going to carry forward and offset gains at some point on your U.S. situs.
Yeah, very similar to the Canadian structure, and I think most tax structures in general. I don't know if this is the same for the States, but just as an aside, I know the one nice thing about owning rental properties in Canada personally, that the actual losses that you do have, you can offset T4, or for you, I think it's W4 or whatever.
W2 income.
W2 income is our T4 income. So we can actually, if you make $100,000 and you have $10,000 of rental property losses, you can offset your personal income. I don't know if that's the same for the States unless you are a real estate professional. And I know there's some applicability or rules around that.
Yeah, and you know what? It's funny because we were looking for some way to explain the real estate professional rules. And we just said about 2 months ago, let's just create our own flow chart. So I'll email you.
That'd be great.
I got a 6-minute walkthrough video on how can you write off your passive activity losses. By default, rental activity is a passive activity, but you nailed it. We have income thresholds for being able to take those losses, unless you are a real estate professional, get a real estate professional designation, which in general, so you have to have, in the States, 750 hours into the activity, and it has to make up more than 50% of your professional work for the year. So No, I
was just going to say, it's a nice bonus. I don't think a lot of Canadians realize that they have, that we don't not have to, reach all those thresholds.
And so what's interesting in Canada, I'm not sure what the depreciation rules are, but they might, if they follow our depreciation rules, I doubt they have bonus depreciation like we do.
No, we don't.
That's a nice feature. So that's a good thing. And
awesome. Okay. Well, Chris, listen, I could probably have this conversation for another hour. This is fantastic. But we are kind of coming towards the end of the hour. So, what we'd like to do is, just ask some questions that we ask most people that come on the show. And,
absolutely.
It just kind of a fast round here for your career, whether it's in taxes, accounting, real estate. What was one book that, that you really love to recommend?
I love Rich Dad, Poor Dad.
Yep. Can't say, I'd be lying if I said we haven't heard that one before. And it's definitely a classic. It comes out, it comes up all the time. What's something that you wish you knew at the beginning of your career that you know now?
That property in Nashville would be so expensive. Okay. So what do I wish I knew? I wish I didn't put so much money into retirement accounts. And I wish I would have started investing in real estate a long time ago and studied different cities. And I had an awesome upbringing, awesome childhood. I just didn't get out of Michigan much. I didn't know what was. So I wish I would have studied markets more, kept more money liquid. I wish I would have never bought my first primary residence and saved more money and bought investments earlier.
No, that's great. That's a good one. I haven't heard that as much, but I'm, the older you get and you start really researching retirement savings, and especially if you're a real estate investor, you're like, yeah, I will opt for investing in real estate and have that money work for me. If you don't have to give names, but some early mentors, whether it's individuals, writing books, or somebody that you didn't necessarily know, or people within your career, who were the mentors that kind of created the guy we see today in front of us?
Well, I would say my best mentor is my dad, and he's and my father-in-law also. I've been married. I'm trying to calculate. I'm not good with numbers. Yeah, it's going to be 13 years. Had awesome role models as far as my father-in-law is he's been an entrepreneur for about 40 years, custom beach home builder. And, and my dad, we're retired from Chrysler in Detroit. They just, outside of business, my dad worked extremely hard to give me the opportunities. I was always entrepreneurial. I mean, I was wheeling and dealing baseball cards. No one would play Monopoly with me. I was always trying to, I had a paper route, but they, a good work ethic. And he's just always a good listener, gives good advice. And my father-in-law has an entrepreneurial spirit. So, unfortunately, I ended up starting this practice when I was 27. So unfortunately, I didn't really have too many mentors, and I had some things that I wanted to do that I learned, that I didn't want to do. But I'd say, family, definitely.
So a little bit of the school of hard knocks in the career as well. That's great. Yes. And my final and favorite softball question: first car, make, and model.
Oh, geez, I would say I had so it was my parents' hand-me-down.
All right, this is good. Keep going.
Yeah, it was a Caravel, a Dodge Caravel, probably I started driving in 91, and we were going to hand me down about 1990, 1989, 1988. And it was maroon. It was kind of ugly, but it had a fake convertible top. So it looked like it was a convertible, but it wasn't.
Yeah.
And that was kind of good because in Detroit, you wouldn't use your convertible 9 months out of the year anyway. So if we were out cruising and trying to see what's up in the town, it looked like we had a convertible. But
that's amazing. And the funny thing, for people that don't know cars, if you saw I think it was Plymouth too, right? If you saw this car, you would know exactly what Chris is talking about. And that's fantastic. You had the old school grill on that thing too.
It might have been a Plymouth Caravel. You know what? It was.
There you go.
It was Plymouth, not Dodge. Dodge would have been too fancy for us, so we went with Plymouth.
That's amazing.
I'm looking at a picture of it on my other screen right now, and I'm like, I think it was a 1988 Plymouth Caravel.
Just an American icon. That is fantastic. Chris, where can people reach out to you? I wish we had more time, and we'll have to have you back on maybe, later in the year, early next year. But if people want to get in touch with you, if they have any questions as a result of this podcast, where's the best place?
Right. I'm happy to help people out. I would go to realestatecpa.guru, realestatecpa.guru. If you just put your name and email and we'll get an inquiry. I'll reach out. If it's something easy and quick, of course, every quick question has a long answer and vice versa. But if it's something you just need a little help with, we'll just reach out. If it's someone that's looking to partner with a CPA firm, we would actually have an initial consultation. But again, I don't want to, if someone just has a quick question, there's no reason to set up a formal meeting and look at tax returns. So I'm just happy to help people out. I'm very blessed to have the opportunity, and I've learned so much from other people. So it's kind of like, what good's knowledge if you don't pass it on to someone?
For sure. Mm-hmm. My guest today has been Chris Picciurro. Chris, thanks for coming on the show.
My pleasure. Thank you so much. I really enjoyed it.